Hi, I'm Debbie Peverill, and you're listening to the weekly tip from Painless Financial Training Group. Today, I'm doing the second of my tips about year-end tax planning for the 2018 taxation year. This one applies to business owners or people who can take a deduction on their tax return for expenses. So, do you know what an accountant's definition of an asset is? Well, one of them is that something costs more than $500 and lasts for longer than a year. So using that definition, which is very similar to CRA's definition around small tools, if you buy a table that costs $450, you will write off $450 as an expense on your tax return. If you buy a table that costs $550, well, now you're over $500, so now you have to depreciate it. A table would be in a class that is a 20% amount, and because it is new to you, the first year that you own an asset, you can only claim half the normal amount. So the $550 table will be a deduction for you of 10%, which is $55. The second year you own the table, you will be able to deduct 20% of the amount that's left. So 20% of the amount that's left is $99. So here's the conversation about the tip. If you need to buy something and your tax year end is December, you should think about doing it now rather than January. If you do it in December, you get that 10% half rate rule out of the way with only a month of the year. Whereas if you wait till January to buy this table, you're going to only get the $55 deduction for it for all of 2019, and you won't get the 20% until you get to 2020. So the party line around this type of decision is if there's something you need and it's subject to being depreciated, you should consider buying it in 2018, not waiting until 2019.